Will you look at this incredible run in Illinois Toolworks? ITW, the maker of specialized industrial equipment, consumables, and related services. Here's a stock that got crushed right out of the gate in 2016, like so many other industrials, plunging down to $81 at the end of January. But in the last 2.5 months, Illinois Toolworks has come roaring back, with the stock trading up to a new all-time high today, closing at nearly $105. That's a monster 30% gain in a very short period of time. In fact, for the last few weeks, it's come to feel like ITW is a permanent resident on the 52-week high list. And the stock has run up so much that I think some people are believing, it maybe it creep into overvalued territory versus both the rest of the industrial sector and the market as a whole. So is it time to ring the register on an industrial that's gotten overextended? Or could this thing have a lot more room to run? Illinois Toolworks is the most emblematic of this entire buy the cyclicals bull market I've been talking about. It's the apogee. Does it deserve to be so? Before we get into the valuation question, let's deal with something far more basic. What does Illinois Toolworks do? It's mentioned, but what does it do? All right, this is an old company founded more than a century ago based on an improved method of gear grinding. Of course, the Illinois Toolworks of today is a very different company, as in Toto, we're not in Illinois anymore. ITW, as everyone on the street knows, that's what they call it, okay, is this diversified industrial with over $13 billion in sales, operations spanning across 57 different countries, but they're still focused on making specialized manufacturing products. ITW serves a host of end markets, including deep-sea oil rigs, aerospace, technology, bridges, wind turbines, healthcare, construction, automobiles, mobile devices. For example, in the auto business, they make improved fasteners, snap-in door handles, powertrain mechanisms, and refueling systems, not to mention numerous products used by mechanics to help keep cars on the road. They make state-of-the-art ovens, dishwashers, and refrigerators for restaurants. Their packaging products help with everything from 6 packs of beer to fresh produce. ITW makes diagnostic machines that ensure the safety of massive objects like suspension bridges and airplanes, as well as tiny objects like heart valves. They even have a semiconductor test and measurement business that only serves the smartphone market. That's a pretty big pastiche of even a mosaic of different businesses. Yet Illinois Toolworks seems to have no trouble managing them all under one roof. The stock hasn't just been an outperformer in the last few months. It's been roaring steadily higher for years and years. Ever since the generational bottom in 2009, ITW shares have more than quadrupled, up 320% from the Great Recession lows at around $25. Stock stuttered a bit in 2015, declining by 2.1%, but that was still much better than the average industrial, given the Industrial Select Spider ETF, which is known as the XLI, declined by more than 6% this year. And after some initial pain in 2016, Illinois Toolworks has just rocketed here. So how exactly is it that the company has managed to perform so well and so consistently and so much better than pretty much everybody else? Why is the whole so much better than its disparate parts? Okay, that's because back in 2012, Illinois Toolworks conducted a comprehensive strategic review, and around the same time, they promoted Scott Santee to the CEO position after the illness and then unfortunate death of his predecessor, David Spear. This strategic review had 2 big takeaways. ITW needed to shift its growth focus from an acquisition-based business model that was no longer viable to one based on generating what we love on Mad Money, organic growth. And second, the company needed to leverage its scale to deliver best-in-class margins and terrific shareholder returns. Management took those conclusions to heart and wasted no time making these new strategies a reality. ITW decided if they were going to be involved in a particular business, it had better be a business that's capable of delivering robust organic growth. That was a huge shift, and the company only exited 32 businesses worth $4.9 billion in revenue, but they were mostly commoditized product lines with low margins. They either shut these divisions down, or in the case of their industrial packaging segment, sold them to other parties. By trimming the portfolio of these superfluous businesses, ITW was able to simplify its support structure, create a leaner, more competitive operation that would be able to pick its spots and only enter into markets with lucrative growth opportunities. At the same time, the company began using its scale to improve procurement process and cut costs. This is basic business. I love these kinds of stories. Just how companies make things in America. One more thing. After that big strategic review, Illinois Toolworks embraced a new philosophy, and I'm not being metaphorical here at all. They embraced an idea. It's called 80-20 excellence, which is a little too complicated to boil down here, but it's based on the Pareto principle, the idea that 80% of your sales tend to come from 20% of your customers. That's different from Pareto optimal or suboptimal, whatever. What can I say? The guy had some great ideas. The point of this philosophy is to focus on your most profitable clients and products. Companies try to do that. This one's actually pulled it off. For ITW, that meant becoming a leader in the spaces where it was most profitable and an essential partner for its most lucrative customers, or it got out. And look, the results here are pretty hard to argue with. Ever since 2012, ITW's operating margins have increased by a staggering 550 basis points to 21.4%. That's astonishing. From 2012 through 2015, the earnings per share increased by a 17% compound annual growth rate. Very impressive, cyclical or otherwise. In short, Illinois Toolworks embraced a new long-term strategy 4 years ago. And ever since then, the company just keeps getting better and better and better. 2016 will be no different. You can't argue with the numbers here. The numbers are stellar. Which brings me back to this valuation argument. Because remember, there's two components to every stock. There's what the company's going to earn and then what you pay for it. Illinois Toolworks has proven itself to be a superior industrial, superior attitude, superior state of mind, which is why its stock is so hard to kill, and why I'm comparing it to one of Steven Seagal's seminal movies. Thank heavens for Netflix, so you can watch that incredible movie after CNBC primetime's over. So shouldn't the stock deserve to trade at a superior valuation? Right now, Illinois Toolworks trades at a slight premium to the rest of the industrial cohort. Does it deserve that? If anything, you know what? I think that the stock ought to have an even higher valuation. That's one of the reasons why I want to talk about it. I think the stock's too cheap. Remember, ITW grew earnings at 17% the last 3 years. In 2016, and for 2016, the analysts are looking for 6.6% growth. That's a bit of a slowdown. Well, on a constant currency basis, ITW is looking for 10% earnings growth, a number that could become a lot more realistic if the dollar continues its recent decline. X today, of course. However, even that 6.6% earnings growth figure is a lot better than what you're seeing from most other industrials. This is an industry where the earnings are expected to contract by 7.8% in the first quarter of 2016, even as they might grow at a 4.7% clip in the second quarter. ITW is leaving the rest of its cohort in the dust. At a time when growth is so hard to find, they've got a decent amount of it, and that's why the stock keeps making new highs. Now, those are the numbers. But the softer side of this argument may be even more compelling, which is that Illinois Toolworks has a good strategy with a focus on differentiated products, and they've proven they can execute. Remember, ITW dumped all that commoditized business years ago. You know, I don't like commodities. I like proprietary. It means it's more difficult to switch from their products to some Japanese or European manufacturer because they might be the only company making this stuff. That's how you protect your earnings. So here's the bottom line. Sure, Illinois Toolworks has it's gotten a bit expensive. I'll give you that. But I think it deserves that. I think it deserves to trade at a premium to the industry. So this is what I do. The company reports a week from today. It's run up dramatically into the quarter. I recommend waiting for the results to come out and then buying it into any post-earnings weakness or weakness caused by any other industrial that reports later on. ITW is just too good to ignore. And we're putting it in the pantheon of the industrials in Cramer. The best company that most of you have never heard of until now. All right, there's much more Mad Money ahead, including the revolution happening in hospitality.